The term Indian obligatory reform or structural reforms intuitively refers to the set of large-scale unavoidable changes India made to its economic policies and governing structure. These reforms were obligatory because they were primarily forced upon the country by a severe financial crisis. Intuitively, India's economy was like a large house with a rusty lock on the door, license Raj. Only the government had the key, and the house was running out of money. The obligatory reforms were the decision to break the lock and throw the doors open to the world. Origin of the concept. The origin, 1991 crisis. The reforms were initiated in 1991 under Prime Minister P.V. Narasimha Rao and Finance Minister Dr. Manmohan Singh. They were obligatory because India faced a balance of payments (BOP) crisis. The country's foreign exchange reserves had dropped so low that it could barely finance 3 weeks of imports, and it risked defaulting on its international debt. The conditionality. To secure a bailout loan from international bodies like the IMF and the World Bank, India was compelled to implement drastic structural adjustment policies. The old system, the license Raj. Before 1991, India followed a socialist, inward-looking model. The license Raj meant a business needed a government license for virtually everything, starting a factory, increasing production, importing goods, etc., leading to massive red tape, inefficiency and corruption. Function, the LPG model. The primary function of the obligatory reforms was to transition India from a state-controlled economy to a market-oriented one, encapsulated by the LPG model. Term. Intuitive function. Policy change. Liberalization. Loosening the government's grip. Removing restrictions on private businesses and investment. Abolishing the license Raj for most industries. Privatization. Selling off government businesses. Shifting ownership from the public sector, government, to the private sector. Disinvestment in state-owned enterprises, PSUs. Globalization. Opening the borders. Integrating India's economy with the global economy. Reducing import tariffs and inviting foreign direct investment, FDI. Key initiatives and benefits. Key initiatives, 1991 onwards. Trade liberalization, slashing high import tariffs and dismantling quantitative restrictions on imports. Financial sector reform, deregulating interest rates, strengthening prudential norms in banking, and opening up the financial sector to private and foreign competition. Tax reforms, reducing corporate and individual tax rates to be more competitive and simplifying the tax structure, a process that continues with GST. Benefits. Higher economic growth. The reforms unlocked the potential of the private sector, leading to a significant acceleration in GDP growth. Increase in foreign investment. FDI inflows surged dramatically as foreign companies could finally enter the Indian market without prohibitive restrictions. Consumer choice. The end of monopolies brought a variety of high-quality goods and services to the market. IT and services boom. By creating a flexible private sector-friendly environment, the reforms were instrumental in the explosive growth of the information technology, IT and services sectors. Incoming updates and future focus. While the 1991 reforms were obligatory, the focus of modern reforms is on continual improvement to stay competitive. The current agenda is often referred to as second or third generation reforms. Focus on ease of doing business, simplifying procedures, promoting digitization of services, e.g., GST network, Digital India, and decriminalizing minor economic offences to reduce the Inspector Raj and compliance burden. Labor code consolidation. Replacing over 40 complex, old central and state labor laws with 4 labor codes to standardize rules, improve worker protection, and offer businesses greater flexibility in hiring and firing. Digital governance. Deepening reforms in data privacy, cybersecurity, and digital payments (UPI) to support the transition to a knowledge-based economy. Deepening sectoral reforms, continued efforts in strategic disinvestment, and pushing for land and labor reforms to boost the Make in India manufacturing drive and integrate MSMEs, micro, small, and medium enterprises, into global supply chains.